Hello and welcome to Connected With Latham, where we discuss ideas, legal developments and business trends shaping the global economy. I'm Rob Moulton, a partner in Latham & Watkins' London office. This is the first of a 10-part series complementing Latham's 10 key focus areas for UK regulated firms in 2024 report. In this episode, we discuss the regulatory reform of the UK primary markets. To discuss this topic, I'm joined by my colleague from the London office, partner Mark Austin. Mark, welcome to the podcast.
Thank you, Rob. Good to be here. Thank you for having me.
And so, UK primary market reform, it's been a big ticket item, but like anything of importance, there'll be some background. So you can just give us the brief background on how did we get to where we are?
Sure. So it's been a journey. I mean, I think it's fair to say, a journey which I think we are nearing the completion of, but it's a journey that started really, well, we had two start points. 3.5 years ago, back in Q4 of 2020, was when Jonathan Hill was asked by the Treasury to do a UK listings review to try to see how the UK listing regime in its primary markets could be updated and made, as I call it, match fit. That, however, the catalyst for that review in the first place was a referendum back in 2016. And I think it's fair to say that referendum provided an opportunity for the London markets, the UK markets, to address some of the friction points that we had been developing over really the last 10 or 20 years. But before the referendum, we didn't need to address them because we didn't have to. And also, when we looked at them, we also thought, quite a lot of those are quite hard, actually, because it's not just legal and regulatory reform that we were talking about. It was also changing market practice, to some extent changing culture, changing the way that we approach our regulatory system and how our markets function. So the referendum provided a catalyst for us to actually do that, partly because we had to, partly because it was the right thing to do. So Jonathan Hill's review in 2020, which I helped him with, was the first sort of step in that process. And then some of the changes from that already have come through, things like moving from a 25% free float on the UK main market down to a 10% free float, for example, being able to have dual class shares, on which more in a bit. And following that review, the FCA moved with alacrity and vision to their credit, as did Treasury and various other government departments. And we had a whole series of other reviews as well. There was a secondary capital raising review, which I did for the then Chancellor back in 21 into 22. We had Ron Khalifa's FinTech review. We had the Edinburgh reforms, we've had the Mansion House reforms, we've had the new Financial Services and Markets Act, a whole welter of reform initiatives across the market that frankly just demonstrate, I think, that London still has the desire to be innovative and to keep itself match fit on the global stage. So that's really the background to where we are today. And it's has culminated just before Christmas with the FCA putting out a further consultation paper, which really is the final step in the reform of the listing regime itself. And so the actual legal and regulatory reform. And that is now running until March this year. But as I say, it is only one part of the reform journey.
So Mark, just summarise for me the key aspects of these new proposals.
So really the key aspect of these proposals are to collapse the listing segments that we currently have down into premium, which are currently premium and standard, down into one single listing segment. That was something that was first raised in Jonathan Hill's review back in 2021. And really that is there for simplicity. The premium listing segment had become burdensome for issuers, not necessarily understood or needed by investors. And the standard listing segment had become something of a poor cousin. And so there was a desire to simplify our listing regime and make it simpler to use. And then the other changes are really philosophically moving the listing regime back to where it was back when the London Stock Exchange handed over listing responsibility to the old FSA, as was, which was the precursor of the FCA, which was very much a disclosure-based regime. So putting the emphasis on putting all information that investors need in front of them so that they can make their own assessment of whether or not they want to invest in a particular company or not. And that, as I say, that's where we were. But over the last 10, 20 years, we've increasingly put a more and more black letter into our listing regime handbook to the extent that actually it's become pretty unwieldy and not necessarily that fit for purpose. So it's moving, the whole thrust of the proposals is moving back to a disclosure-based approach, which does carry with it, potentially, as the FCA has recognised, a bit more risk. But they recognise that a capital market needs to involve a bit of risk. If you take all risk out of a capital market, you're probably going to have a pretty sclerotic market. And that is, to some extent, what has happened. In more detail, what these proposals do is they relax some of the eligibility requirements at the point of entry into the new single listing segment for commercial companies. So, for example, you won't need to have a revenue earning track record anymore. You won't need to have an independent business anymore. You won't need to have control of your business anymore. And then there are also some key changes once you're listed as well. So the need for a shareholder vote. You need to get a vote by shareholders on significant transactions, big acquisitions and big disposals will go. And that will be replaced by a need to announce it with prescribed content requirements in your announcement around the transaction, which is similar to other markets. And the same with related party transactions. At the moment, over a certain size, you need to get prior independent shareholder approval for a related party transaction. That will go. And you will need to consult a bank, potentially get a fair and reasonable opinion, but you won't need shareholder votes. And that, again, as I say, is meant to put the emphasis back on disclosure and investors being able to make their own assessment of whether they want to stay invested in an issuer or not.
So the changes have been billed as pretty transformative, narrative changing. Are they going to be enough to give the UK markets the kickstart that the city and the government are hoping for?
I think they are. I mean, there's been a lot of consultation on them over the last 3.5 years. I mean, there's a fairly speedy consultation, this, and that's because they've been well-trailed, these changes. I would characterise them, Rob, I think, as necessary but not sufficient. So they are a key part of the reform package that we're putting together, the reform journey that we're on in the London markets, but they're not sufficient in and of themselves. But what they what they will do when they come into force at the start of H2 this year, all being well, is that they will remove the friction point for the UK compared to other key global listing jurisdictions. We had got to a point where the regime that we had was seen as overly burdensome and actually a bit of a deterrent of new issuers using our markets, as well as for existing issuers. And what these changes do is take that friction point out. As I say, though, reforming our listing regime and these legal and regulatory changes are just one facet of what we're doing. In other areas, in particular around market practice, there's a lot of work, for example, going on at the moment, and this has hit the press a bit recently, and there's much more in H1 that's to come, around, for example, corporate governance and remuneration. There's another friction point that's being addressed, where we're trying to create a level playing field on remuneration, for example, with other jurisdictions around the world. Because at the moment we do, it's fair to say, have a fairly prescriptive, sometimes restrictive remuneration regime. And actually that can act as a hindrance to people using our markets too. And as I have said many times over the years, there's no point in having a theoretically perfect market if people choose to use other markets. You've got to make it something that's attractive for people to use. So that whole market practice area around remuneration, around corporate governance more generally, which the government, to their credit, realised, and there was a revised remit letter sent by the Department for Business and Trade to the Financial Reporting Council alongside the autumn statement last year, emphasising that in recasting the stewardship and governance regimes, the FRC should take into account the UK's economic growth and its international competitiveness of its markets. So that's another key area that's where things are moving pretty meaningfully. And then the final sort of big area is around actually trying to change the narrative and trying to change the mindset in the UK markets. I think we had, people recognise this now, become far too risk off rather than risk on. And a sort of market where you can make a 2% return, but you couldn't make a 20% return, which obviously means you're losing out on 18% of returns. To give a sort of clumsy example, I suppose, but it's trying to get that element of risk back into the whole ecosystem, all the way from scale-up capital through pension trustees, through regulatory approach, through users of the markets, being prepared to investors taking more risk in their investments as well. And that mindset, that sort of mindset change, is also a key part of removing the friction points that I think have built up.
And so bearing in mind that mindset change, Mark, what are your predictions? What do you think UK capital markets look like for 2024?
I think that by the end of H1 this year, we will, as a market together, have successfully addressed the key friction points, and we will have made ourselves match fit again as a global capital market across the legal and regulatory space, across market practice, across the mindset. We're also doing a lot of work on capital deployment and driving more money back into UK equities. And I think that, if you look at it from a 60,000 feet point of view, Rob, that is a fulfillment of our mission statement, really. I mean, I think we all recognise that private markets are here to stay. I mean, they are clearly exploded in recent years. You know, the alternative asset managers are here to stay. They're expanding into new products all the time. We see companies staying private for longer and being able to fund themselves in private markets very effectively. But continuation funds and secondary funds can only go on so long. I think everybody recognises that. There is always going to be a place for public markets. Private markets are always going to need public markets. There is a big backlog of private companies who are going to need to access the public markets, either for capital in terms of the quantum that they need, or for exits for their current investor owners. The UK's mission statement has been to make sure that when that need for the public markets comes back, and that's a global phenomenon, that London is once again the viable alternative to New York. For companies for whom New York, which is the largest capital market, let's not make any bones about it, it's not the panacea for all ills. It's not right for everybody. And we need to make ourselves match fit so that for companies for whom New York is not the right answer, we are again the obvious alternative, and we've reduced the friction points that have built up. And I do genuinely think that by halfway through this year, we will have done that. And then it's a bit like, Rob, in Kevin Costner in Field of Dreams, you've got to believe that if you build it, they will come.
On that note, Mark, great to talk these topics through with you.
Well, thank you very much, Rob. It's been a pleasure to join you. Thank you very much for having me.
Thank you for listening to this episode in our Connected with Latham podcast series. And you can subscribe and listen to new and archived episodes of our podcasts on lw.com, Apple Podcasts, Google Podcasts, Spotify, or wherever else you get your podcasts. If you'd like more information about the topics in this podcast, or access to our 10 key focus areas in 2024 report, please visit the links located in the show description, and do stay tuned for more episodes.
This podcast is provided as a service of Latham & Watkins LLP. Listening to this podcast does not create an attorney-client relationship between you and Latham & Watkins LLP, and you should not send confidential information to Latham & Watkins LLP. While we make every effort to assure that the content of this podcast is accurate, comprehensive, and current, we do not warrant or guarantee any of those things. And you may not rely on this podcast as a substitute for legal research and/or consulting a qualified attorney. Listening to this podcast is not a substitute for engaging a lawyer to advise you on your individual needs. Should you require legal advice on the issues covered in this podcast, please consult a qualified attorney. Under New York's Code of Professional Responsibility, portions of this communication contain attorney advertising. Prior results do not guarantee a similar outcome. Results depend upon a variety of factors unique to each representation. Please direct all inquiries regarding the conduct of Latham & Watkins attorneys under the New York's disciplinary rules to Latham & Watkins LLP, 1271 Avenue of the Americas, New York, New York, 10020. Phone number 1-212-906-1200.